Hi, and welcome to this special edition of my podcast today. Now, as you would know, well, obviously this is we're actually making a bit of history. It's the first video, and I'm pretty excited about it. Now, I know a lot of you are actually listening to my podcast while you're driving, or you're actually working in a garden, or you're preparing food. So please go do what you always do. What I'm going to do about this. With this podcast as well, I'm going to make a document available. And if you need any information, go to my website and flick me an email, and I'll send it straight back to you as well. Let's get stuck in today's podcast. Now, what this podcast is about today. Now, as you would know, in season one, we started talking about a profit and loss. I banged on a lot about the gross profit, the break-even point. Then I spoke about your balance sheet and your cash flow. And I also went into your pricing strategy. So all of that is basically what I'm trying to do today. There's a bit of a case study we're going to do, and something that you can actually play with once you get the documents from me as well. I'm going to take you through the first year of say, for instance, the people who wants to start a company. So let's start with this a bit of a story here. We've got two very special people here, Edward and his wife is Cecilia, and their surname is Green. Been married a few years, no kids yet, and they're very involved in their careers. They really want to make something of their careers as well, but they're feeling a little bit stuck in the world. They thought, well, there is something that we perhaps can do, having a bit more freedom, and they believe they have got a possibility to actually work quite nice together. So they thought about everything. They thought about starting Airbnb business, or perhaps buying a nice quirky coffee shop in a trendy part of town as well. They were always thinking about this. Edward, he's pretty much in robotics. He works for a big company supplying the defense industry here in South Australia. And Cecilia, she's also involved with a medium-sized law firm. She knows a lot about business law, digital marketing, and all the social media involved that. She knows a lot, which is great. So they thought about, wow, geez, it would be nice if we can actually start something where we can take our skills and put it together. So one day decide, okay, well, perhaps we'll take a bit of a drive. Just it's in the middle of the week. It's a nice sunny autumn afternoon, just after vintage. So they reckon, they want to go and do a bit of wine tasting. They decide they'll take a drive into the Barossa. And they came to a quirky little, I should stop saying quirky so much. Anyway, they came to a nice little salad door, and they sat outside on the patio. It's a beautiful lawn in front of them, and then vineyards. And it was quite quiet. But I heard something in the background, some kind of droning sound. And I was wondering, and obviously as in the inquisitive couple that I are, they decided, well, they're going to go and investigate. So they left their platters and the wine on the veranda and just like walked around on the lawn. And then behind the corner of one of the buildings, they saw this little contraption. Well, it's not a little contraption, it's a funny contraption, about the size as a bit of quite a big automatic pool cleaner almost. And I looked at each other and said, well, this is, and the thing is actually sort of like tilted. So it's trying to get back on the lawn. So they said, well, this is a automatic or a robotic lawnmower. I said, wow, that's interesting. And having a look, and Cecilia automatically starts taking out a photo camera, and starts taking photo of the machine. And Ed was like wondering, he's scratching his head. Well, that's interesting. I wonder how this works. I mean, obviously he looked into something like this before, but never really was so upfront with it. And then a maintenance manager of the estate came with his little golf cart there, and he's like a little bit frustrated. And he said, "Oh, yes, bloody lawnmower is not working again. I told the people, buy me a decent sized lawnmower, and we'll just get one of the students to come in once a week and do stuff." But they had to spend like $2,000 to buy this robotic thing, but it doesn't work. The software doesn't work. There's it comes from Singapore. There's an agent in WA, but he's in Western Australia. he's not really coming to the party, and it's difficult to get all the software upgrades from Western Australia, from Singapore. And Cecilia and Ed looked at each other and said, "That's it, that's the gap in the market. We're gonna build lawnmowers." They didn't say it to themselves, but they knew exactly what they're gonna do. So they actually went back to finish their wine, their snacks, but I actually stayed there. They started writing business plans, and they were really excited. This is something that can work. This is something, if they can really dig into the market, understand the market, get a niche market, they would actually be able to make and produce and sell a lawnmower, automatic lawnmower made in Australia, made in South Australia, for people that really need something specific, and that will give the edge. So edge, no pun intended. Anyway, so they went back to the drawing board. They said, okay, what do we need to do to get this business off the ground? And they had to look at their bank account. They had a call with the bank. They said, okay, they got about 200,000 in equity in their home loan, meaning they were fortunate enough a few years ago in Adelaide to buy a property just before a big boom. So they got it at a bargain anyway, and the property grew. They paid a decent amount of money, so they got easier extra 200,000 in equity on their home, which the bank says no problem. We can make it available in cash. Okay, so they know they got 200,000 in cash to start a business. So, and now I want to take you back to one of my episodes where what I've done about the balance sheet for the 5th episode, basically. And as I mentioned to you, that's always usually your first entry anyway when you start a business in your balance sheet. So that 200,000 goes in the bank. So they get it from the bank, but they put it into a bank of the business. Or not yet, they're going to start a business soon, but they will be able to put that in. So that 200,000 goes in the bank. Now, how does the balance sheet work? As you might remember that I said it's your assets. Your assets equals your liability plus your equity in your business. All right? So if you do one entry here, and this is like bookkeeping 101, but I understand a lot of us are business people. We probably, we might not have studied bookkeeping back then, but it's just, I'm just going back. So first entry is you got 200,000. That goes into the bank. Then double entry, bookkeeping 101, 200,000 goes into your equity department, equity of your business. Now, I don't know if you people can read when I'm just trying to keep my writings to the camera there. So equity is 200,000 and your bank is 200,000. So that's your balance sheet. Now, remember what I said, it's your assets plus your liabilities. No liabilities yet, plus equity. So assets 200,000, equity 200,000. So that is then what I would start off as well. So Cecilia and Ed, or Seals and Ed, as I would like to call them, and his surname is Green, quite apt as well, and not only the fact that I'm writing with Green, but I want to get into the lawn mowing business or robotics business. So what is the industry? And well, it's not exactly totally lawn mowing business, but it's not exactly robotics either. So it's a bit of a mixture. So it's an interesting industry. There are a few competitors made locally in Australia as well. So Cecilia really start digging her teeth into doing research in the market. Is what does the market want? What does the market want? What is currently in the market? Where does it get exported from? Who are the agents? How does it get sold? Does it get sold online directly, or is it retail? It was non-stop busy looking at product development and how does it work? How does it all fit in? So obviously from this 200,000, they had to start paying some money to an engineer to help a little bit with design and product concept development. So they then came to the conclusion they're going to need at least another 200,000, because this 200,000 will basically be operational cash for the business. But they're going to need at least another 200,000 to invest in machinery and plant and equipment. So they went to the bank and put the whole thing through, and the bank said, well, you might have still a little bit of equity in your house left, but as a matter of fact, we'll have to look at a loan, and perhaps we can loan against the actual assets that you put in. So they start writing a business plan. They also contracted and spent a bit of money on consulting accountant to help them with a business plan and a business projection and a forecasting and all those number kind of stuff. And I went back to the bank and with presenting this nice, beautiful business plan to the bank, and the bank would say, okay, right, we can give you another 200,000, but that will go straight into your plant and equipment. So let's just have a quick look. And I know it's quite basic, and a lot of you say, well, why do I explain all this stuff again? But it's always nice just to go back and have a bit of a put yourself aside and do a bit of a perception of how does the balance sheet and everything starts fitting in. So as you would remember, we had the bank here, we had 200,000. Now we bought assets, we bought plant, which the bank is part of the assets. We bought plant of another 200,000 here. We got a loan of 200,000, and then we got equity as 200,000 as well. So as you would see, that's your liabilities and that's your equity, and this is your assets. So you've got 400. So again, your balance sheet balances your 400, and your assets equals your liabilities and your equities. So I guess I'm reinstating that figure, so it's bringing it back to life. I'm going to sit down here as well a little bit, and I'm just going to read over some of my costings that I've done here, which Ed has been pretty much involved. He said, okay, well, once we got the production and the plant sorted, we need to go into production. How much is it going to cost us? And he's done a lot of scenarios, and he worked out how his production line is going to work. He's going to need direct labor, and he reckons it's going to be about 6 hours to assemble one of these machines. There will be a little bit automation in the factory, but a lot of the stuff is manual. So 6 hours, and perhaps at a rate of $35 an hour. And then also a lot of materials that he's going to need to put into this machine, direct materials. So probably in the region of about $250 worth of materials per machine, which in accounting or production terms, we like to say, we call it your bill of materials. So as I mentioned in one of my first episodes, your cost of sales, or your cost of goods sold, usually depends on your direct labor and in your bill of materials as well. So now we've established that your direct cost in a business to make one machine is going to cost you $460. So that is your labor of, let's say, $210, which is 6 times 35 hours. 6 hours times $35 per hour, and then your bill and then your equipment as well. With the costing sorted out, they need to go back to the pricing strategy. Now, as you would remember, when I spoke about pricing, I said, when you're doing pricing, we can go, there is basically 3 strategies that you can follow. It's a cost-based strategy, it's a value-based strategy, and it's also dynamic pricing. Now, dynamic pricing is quite dynamic. It's, as I mentioned, it's very up to date, second by second kind of pricing changes all the time, like airline tickets or Uber, those kind of stuff. So we're perhaps not gonna worry about that too much. Cost-based pricing is basically when you got your pricing there, and you would know, well, you got to put a markup on. That's my price. I'm going to pay, and that's it. And you just lock it in. But for this industry, we really got to look at value-based pricing. Obviously, got to take the costing into account here to make sure that it is a viable product that or a viable profit that we are making. So again, Cecilia has been very involved with her research as well, and she came up with the figure after doing all the research that a reasonable price or a reasonable retail price would be $1,289. So $1,289 per unit is what we will launch the product at. Oh, by the way, I think I forgot to mention what we call this product, which is quite trendy, as they like to say. So we're going to call this product your turf bot. All right, pretty nice. We're going to sell one turf bot to the market for $1,289. Is that what we are getting as a company? Is that our income? No, not really, because keep in mind, and I know we've got some international listeners here as well, but for Australia, we got something called GST. So obviously we've got to work out what is the actual income that's going to come to us once we've taken GST into account. Now, the very simple formula here is you take your sales price. Let's say your sales price is 110, and you divide that by 11, and then times that by 10 to get back to your GST price. I hope I'm not too confusing with that, but happily to explain that, off-site if one of you needs to have a bit of a chat about costings and margins and markups and all those kind of stuff. Anyway, so you'll take that amount there, divided by 11, and times with 10. That means your actual price that you will get for your product is then 1,172. Okay, so we've established the direct cost is then your $460, and we've also established that your right price is going to fit right in the market is going to be $1,289, but we had to take your GST part off, because that's we got to give back to the government. So we're getting 1,172, costing us 460. So that means our gross profit is then $712 per unit is what we're making on that unit. Now, we know that will equate to a 61% gross profit margin, which sounds pretty awesome. But keep in mind, we are a manufacturing company. There's a lot of overheads as well, so we can't get too excited yet. Now, by that said, let's look at, and you'll realize that, or you remember that I did speak a lot about your break-even. Your break-even is very important as well for us to understand what do we need to sell, how much do we need to sell to make this, to break even for that matter. And then obviously that's your point, and anything from onwards will give you a profit. The quick formula would be your overheads divided by your gross profit. By your gross profit margin of 61%. but we don't know what the overheads would be. Now I can go into detail in that, and obviously please refer back to the document that I'm happy to send through to you. But all in all, is your overheads would be a total amount of 235,000. So what we need, so now we know what the price is, we know what the we know the cost in gross profit, we know the overheads is 235,000, and we decide, okay, that's what we're going to go for. We're going to put this product out in the market, but we do need to see if we can make a profit at least in the first year. It doesn't have to be much, but it has to be, the company's got to grow, it's got to be sustainable. So how much profit we want to make? Okay, it's debatable. We can say, okay, let's see if we can make a 5% on return on investment. Now, remember the equity, as I mentioned, was 200,000, and 5% of that would be $10,000 gross profit, net profit. So if we can make a net profit of, say, 10,000, we'll be okay. We will know we'll do better than breaking even. What is the formula for that? That's the other question. It is your overheads, which was your 385, plus then your $10,000. If you divided that amount over 61%, which is your gross profit margin, that will give you the amount of sales needed, if you understand what I'm saying. So what we need to do is we need to understand how much do we need to make in the first year to be able to break even, and above also make a bit of a profit. So obviously the formula would be your overheads, which is 235,000 plus the extra 10,000 give you 245,000 divided by 61%. That means that gives us a good idea of the amount of sales that we need to gather. So basically, it's your 245,000 divided by 61%. That comes to an amount of, let's say, 400,000. So you want to do $400,000 in sales for the first year. Okay, so that means it's a bit of a job to sell that amount, to get that income. We know we'll have to sell 415 units. 415 units. We know we got to do 400,000, just over 400,000 in sales. That is translating back to 345 units that we have to sell in the first year. Now, we're only going to start really selling on the 1st of April in the year. So it means we've only got 9 months really. So it's quite a heavy goal that we need to reach. But Cecilia said, don't worry, don't stress. We're going to look at the Australian market. Now we're looking at the domestic market. There's 10 million households in Australia. And also research shows that 15% of these households are likely to replace their lawnmowers in the next 3 years. That gives you 1.5 million lawnmowers might be replaced in the next 3 years. What is the likelihood of that lawnmowers be replaced with robotic lawnmowers? That is, the trends show about 5%. So it gives you, there's a $75,000, 75,000 units of lawnmowers in the next 3 years in Australia. Now, the niche market is perhaps small, but Turfboard probably got 5% of that market. That means we got 3,750 of that market in the next 3 years. That means easily 1,000 a month. So for the next year, to do, 350 units is doable. Anyway, so they set off, they got a business going, they worked on the business and in the business, and eventually 1 year later, they nearly made a profit. They did sell, instead of 345, they sell 415 units, which is pretty good. but obviously they did not take into consideration there's sometimes a lot of discounts involved. So the average amount of discounts given was about 8%. Wages turned up to be less per item. The expenses or the labor cost was a bit higher. Instead of $35, it went out to about $36 an hour for that matter. So all in all, their gross profit instead of 61% was about 53%. The overheads was a little bit higher. There's a lot more engineering cost than planned as well. End of the day, they made a loss of $34,000 as opposed to $10,000. That's how the situation looks. So, in terms of wrapping it up, so there's probably been a lot said. There's a lot to read between the lines. I thought I'll keep it. I'll just sketch a little bit of a scenario here and give an idea how it all looks. But what my point is, we need to understand how everything gets worked together. You know, from the inception time of starting the business, the balance sheet entries, then the costing, the profit and loss, and eventually how it looks in the balance sheet. So, for that matter, when you look at a balance sheet, they all it still balances. Obviously, you had your 200,000 here in equity in the beginning, just bringing us back to the equity, and then you got your minus your 34,000 loss or 35,000 loss that you made. So you got an equity of 166,000 for that matter. Okay. Now you got your loans. You had your 200,000 loan. If you remember in the beginning, I said we're going to take out a loan for the plant and equipment. Obviously, there's been capital paid off. So after that capital has been paid off, the end of the year, we're sitting with 172,000 there. And that comes to a total of 338. Your liabilities plus your equity. Now we know that assets should be the same, and that's how, let's see if it balances. So we know our bank, we had 200,000 in the beginning, minus your loss, and then also minus your inventory, because we have to keep stock on the books of 25,000. It doesn't have to be 25,000. I just took that figure. It can be anything really, but in this case we took 25,000, and we had your plant of 200,000. Your plant, which is your equipment, of 200,000. There's depreciation involved, which came off the profit and loss of 25,000 as well. So it means the end of the day, you had your bank 138,000 here because you paid your inventory and you had a loss. Now the loss is to do with cash, as your cash flow loss. I'll just come back to it in a second to that as well. You will then come to a figure of 338 there. So 338 in your assets and 338 with your liabilities and equities. All right, we know we made a loss of $34,000 in the first year. Okay, but including in your profit and loss was depreciation of $25,000, and you also had your interest. Now, we don't take bank payments into account for the profit and loss. We only take the interest into account for the profit and loss. Now, the interest that we've paid, let's say 14,000 for that matter. So we add that back to the profit, and you are left then with a positive figure of, let's say, about $4,000 if you add it back. But now, in terms of the cash flow, we've got to take the cash payments back, or we've got to take the cash payments off, 41,000, which we've got to take off. So that 41,000 gives us the 37 there. That is the amount that I then subtracted from my balance sheet. Hopefully it makes sense. I know I've been running around to different scenarios on this whiteboard here. But if you understand if you have a look at a balance sheet, that 37,000 went off your 200,000 that you had in the beginning there, minus your 37, and remember your invent. Yeah, I've said a lot of things. I've tried to explain a little bit in the background what's going on, but the most important is for us to understand. My information will be available, and I will then leave us with that. We'll call this a wrap for now, and then obviously in a few weeks later, I will go back to the scenario that I sketched, and we're going to look at capital expenditure, because the company will probably want to grow in the future. How are we going to handle that as well? So anyway, for me, I'll be signing off for now, and please look at my website. Send me a request, and I'll send the schedule through to you as well. Happy to have a chat about it. Anyway, hope that we'll catch up soon again. Cheers.